Hi, I'm Jimmy Atkinson with the Opportunity Zones database at opportunitydb.com, and welcome to today's webinar, Mobile Home Parks, the perfect recession-resistant Opportunity Zone investment. Let's find out. Today's sponsor is Saratoga Group, and some of the things that we'll be talking about today include the economic advantages of mobile home park investing through an Opportunity Zone fund, how mobile home parks, or MHPs as we'll abbreviate throughout today's webinar, offer a simplified management solution, why MHPs may offer superior risk-adjusted returns, and then we'll also spend a little bit of time comparing MHPs to other asset classes commonly held by Opportunity Zone funds, and why MHPs may outperform during recessions. And then most importantly, how you may be able to incorporate this type of investment into your portfolio. So before we get started, a few things to keep in mind. One, yes, I get this question a lot, so I'm going to address it right at the top here. This webinar is being recorded, and we're going to send out a follow-up email to everyone who registered on details for how to access that recording. That email should go out tomorrow afternoon. Two, yes, you will have the chance to download the slide deck, and we'll have instructions on how to access the slide deck at the end of today's webinar, and that will also go out in the follow-up email that we'll send tomorrow. And three, yes, we will have time for a Q&A session at the end of the webinar today. We're going to try to leave about 10 or 15 minutes for some Q&A at the end. If you do have a question that you'd like to ask our expert, Sam Hales of Saratoga Group today, please use the Q&A icon in your Zoom window. We also have a chat feature, which comes in handy if you want to chat amongst yourselves or send me any questions or just kind of informally chat with each other during the presentation. But if you want to actually submit a question to Sam for the Q&A session, please use that Q&A icon. Also throughout the webinar, we're going to be asking you some questions. We have 3 poll questions that we're going to be asking today. We're going to get the results out to you right away, and they will be completely anonymous, so please feel free to answer honestly. And just before I do turn it over to Sam, one legal disclaimer. The following presentation, don't consider it an offer to buy anything, and do not consider this to be investment advice. Please consult with your professional advisors before making any investment decisions. So now, without further ado, I'd like to turn it over to today's guest, Sam Hales. Sam is founder and CEO of Saratoga Group, a real estate investment firm focused on investing in affordable housing, specifically through mobile home communities. Sam founded Saratoga Group in 2011 and has successfully managed over $200 million in assets. We're very pleased that he is here today with us to share his expertise. So please, Sam, take it away.
Jimmy, thank you so much. It's a pleasure to be on here today, and I hope that each of you find a lot of value through what we'll be sharing today. So the title is Mobile Home Parks, the Perfect QOZ Investment. Of course, perfect's a tough word, right? And we'll certainly be talking about all the economic advantages of mobile home communities in opportunity zones. But part of the reason this word was chosen is because of the original political intent for the OZ legislation, which was to help disadvantaged communities. And as I often tell people, probably almost every mobile home park or mobile home community has the demographic of people that really should be included in an opportunity zone investment. So let me introduce our team really quickly. We're not going to have anybody else from the Saratoga Group team on the call today, but Jimmy introduced myself. We have our CFO, Becky Smallwood. Becky has just a wealth of experience in the real estate industry at controller and higher levels, including over 10 years with another very large manufactured housing owner and operator here in the Sacramento area. Josh Delcour is our Senior Regional Manager. He lives in Springfield, Illinois. Fletcher Alexander has over 10 years of project management experience in both academia and actually in a large winery, and he joined us recently. And finally, Luke Hales is our COO. He was at ExxonMobil for many years. He lives in Nashville, Tennessee. So we have our main headquarters here in Auburn, Northern California, and then some of the management teams spread out kind of closer to where our investments are.
That's great. So Sam, sorry to interrupt you there, but I did want
no
to
problem.
get our first poll question up before we continue. So I'm going to launch that poll right now. Sam and I were curious what everyone's experience level is in mobile home park investing before we really dive in. So before we do continue, really simple question today. What is your experience level with mobile home park investing? Are you very experienced, somewhat experienced, or do you have no experience at all? So we're going to give you a few more seconds to answer this question. It should be right there in the middle of your screen. We're getting a lot of people still voting here, so I'm going to give you just a few more seconds to answer this question. What is your experience level with mobile home park investing? And again, all of these poll questions today are anonymous, so feel free to answer honestly. We won't hold you to anything. So just a few more seconds here, and I'm going to end the poll. And there we go. So we got 79 people to participate in the vote here, Sam, and it looks like the majority have no experience with mobile home park investing. So that's great. I myself do not have any experience in mobile home park investing, so I can be lumped in there as well. A few people with some experience and a few people very experienced, possibly on rivaling your level, Sam. So, but for the most part, the most of our audience is coming in here with little or no experience. And so it's great chance for them to learn more today. So Sam, what do you think? You want to continue?
Yeah, awesome. Well, no, I appreciate that backdrop because that does help kind of tailor a little bit what we'll talk about. And so what first thing here is in terms of the advantages of MHC or MHP. MHC meaning mobile home community. They're kind of used interchangeably, those terms, but of investment in these sorts of communities. First one is simplified management. So if we think about this is what's called a land lease community. So we own the land and we own the improvements on the land, which are going to be the roadways. It's going to be electrical distribution, it's kind of common area lighting. It's going to be sewer lines, water lines. But other than that, typically the residents own their own homes. And so when you think about if we're comparing this, let's say, to an apartment building where we're going to own all the walls, and if the roof leaks, we got to fix that, and the windows leaking, and just all those issues that are going to crop up, we don't really have those issues in a mobile home community, and so that kind of simplifies our management. Second thing is what's referred to as the high tenant moving costs. So we call these mobile homes or manufactured homes. Mobile homes is kind of the term that's been used predominantly in the past, and it's changing a little bit in the industry, but they're really not that mobile. And so if somebody is, let's say, living in a community, they own their own home, and they want to move to a different community, that can cost from $5,000 to $10,000 by the time they get the large truck to move. You often have to get permits to do it. You've got to then reinstall your skirting. You've got to install a new deck, stairs, all those sorts of things. And so it creates a sticky tenant base. The average length of residency being 12 years compared to kind of 1 to 2 years maybe on apartment dwellers. The next is fragmented ownership. So there are approximately 50,000 communities in the United States, and less than 3% of those are owned by the largest public owners, REITs such as Sun Communities or Equity Lifestyle. And so what that means is because it's so fragmented, there's a lot of kind of what we call mom and pop owners that have owned these communities and a lot of times don't reinvest into them, also don't keep the rents up to market. And so there's a lot of buying opportunity because of that fragmented ownership. So in terms of risk-adjusted returns, kind of a typical operating expense ratio for a mobile home community is going to be in the 35 to 40% range. If we compare that to maybe a multifamily apartment building, it's going to be 5 to 10% higher than that. And finally is a limited supply. So I mentioned, 50,000 communities or so in the United States. And what's interesting about that is there's kind of a little bit of a moat built around this industry. Every year there are more communities that are redeveloped into other things like a Walmart or some sort of commercial investment versus the number that are new and get built kind of straight out of the ground. It's very difficult to get a mobile home community approved and built. This chart here is showing the reason that I decided to move Saratoga Group into this investment space. So we started out doing single family home investment 10 years ago in Northern California. We've done a number of other different real estate investment transactions and manage those sorts of opportunities. And what really attracted me to this asset class was the fact that it does well in both good times and bad times. So let me explain this chart. First of all, in blue, this is showing across each type of commercial real estate, or really an aggregation of all types of commercial real estate for publicly traded REITs, what was what's called same-store NOI growth over the last 10 years. And you can see that it's generally been positive, meaning each unit, each apartment, let's say, or each office has become more valuable. But here we are in the Great Recession from 2009 through 2010, and as you would expect, those, each unit became less valuable, and because it was generating less income. Maybe there was more vacancy, maybe rents came down. Of course, we're probably staring into a similar situation right now. But what you'll notice is that 10 years ago when this happened, although the NOI growth slowed, there was less growth, it was still growing. So and it's not just each year, it's actually every single quarter, these mobile home spaces have become more valuable on these publicly traded REITs. So there are generally, three different types of opportunity zone funds. So at least from my experience, what I've seen is there's quite a few on the hotel development side, Class A apartment development side, QOZ business, and of course I'm presenting today the Mobile Home Park Fund, which is certainly quite a bit different than each of these. So I just wanted to spend a minute and talk about some of the differentiators. First being the idiosyncratic risk. So if we're investing in a hotel and it's a ground-up development, there's all sorts of kind of risk that goes into the lease up, as far as how long does it take us to get our occupancy rates up, really how is that particular market going to perform relative to a mobile home park fund, where, I'll get to this in a minute, but we're basically purchasing an asset that's already cash flowing. And of course, QOZ business, you think about a startup company and kind of the risks associated with that, it can be very risky. Diversification. So across our OZ transactions, purchases of mobile home communities, and we'll share later kind of what those have been so far, our average purchase price is right around $2 million. So in a $15 million fund, which is like our current Fund 4 OZ fund, we're able to buy 10 to 15 communities that are in different geographies with different demographics, and we're able to diversify kind of geographically and demographically. I already mentioned, these mobile home communities we're buying, they're providing current cash flow. I mean, they're often, our typical occupancy is about 55% at acquisition, and that's true of our OZ parks as well as our non-OZ. So there's a lot of headroom in terms of the lease up, but there's also kind of a baseline of cash flow that we're able to have when we purchase. In addition to that, mobile home communities are known for the ability to generate really good cash flows over time, and there are a number of levers that we're able to use, not just adding occupancy, but in the way that we operate them, maybe billing back for utilities, different things like this that allow us to pretty easily kind of move both the top and the bottom line in terms of our income. And finally, like the slide that I just shared, the mobile home communities in the past have done very well during recessionary cycles. certainly relative to hotel or maybe Class A apartments. We obviously know the impacts right now for hotels, and it's been dramatic and really sad in many ways. Class A has held up pretty well, and I'm going to kind of share that on the next slide. At least so far, what we've experienced in past downturns is that Class A over time, people start trading down from Class A to Class B, from Class B to C, and mobile home communities are kind of considered a Class C type of asset. So that's part of the reason they hold up well during a recession.
Which is very important during the current environment that we find ourselves in. Is that right?
Yeah. In fact, and that's what I wanted to kind of speak about here next, Jimmy, is how it's holding up so far. So on the left, you're going to see a graph or a chart showing kind of some industry survey results regarding collections. And so I'd have you pay attention to kind of that last column. So this is the percentage that's reported there is the percentage of historical collections that they reported in the month of April, right? So in other words, industrial is the top one. So April of 2019, they would, let's call that a baseline of 100%. In April of 2020, they're collecting, close to 92% of what they would have historically. And you can see there's certainly some real pain points, right? Malls at the bottom, certainly all types of retail are having a very difficult time. Manufactured housing across the industry is collecting about 97% of historical, which is the highest of any of the asset classes. The chart on the right is showing our specific experience with Fund 4, which is this Qualified Opportunity Zone Fund that we're operating currently. Hopefully you can read the legend on the bottom, but the blue is March of 2020, red is April of 2020, and green is May. So we actually took the data yesterday, and you'll notice that our collections in April ended higher than March, and our collections in May are already higher than they were for April. And there's a number of factors there. We often are buying these communities from mom and pop owners who aren't always very good about what we call the pay to stay rules, as far as, hey, you've got to pay to be able to live here. And so a lot of times when we buy these communities, we're kind of inheriting a lot of past dues. And so some of what you're seeing there is that, but a lot of it is the fact that people realize that home is a valuable asset and they want to preserve it. If they can't live in one of our communities at an average lot rent of $300, they're not going to be able to live a lot, very many other places. And so we do what we can to help them, but it's also doing very well as an asset class. An interesting point regarding mobile home communities is this social distancing. I mean, we've got it kind of being mandated at some level, but also many people choosing to social distance, and it can be quite difficult to do in a multifamily community, right? You've got elevators, you got common doors and hallways and that sort of thing for a multifamily apartment building. In a mobile home community, each resident typically has their own driveway. They're not sharing any walls with anybody else. They're not sharing an HVAC system. We believe that this may just continue to increase the demand for this type of housing because of some of these social distancing rules that may be with us for a while. The other aspect is, again, we talked about kind of simplified management. It's becoming quite onerous for some of these. I mean, imagine owning some multifamily apartment buildings in New York City right now. Some of the rules and the procedures that they're having to put in place, one person at a time in the elevator and things like that make it very difficult and expensive to operate some of these communities. And we don't really have to worry about that too much with the mobile home communities. Okay, financial performance. So what I'm sharing here is our results thus far in Saratoga Fund 4, our Opportunity Zone Fund. And I mean, you're going to see pretty dramatic increases here from Q4 to Q1 and then amortized for Q2 through yesterday regarding both our gross and net income. And it's, one of the factors here is we closed on a couple more communities in January for Fund 4, and so some that provides quite a boost or a difference there. But the other part is kind of the aspects I was talking about, that as we're moving along here, we're taking care of delinquencies, we're moving people out that aren't going to pay, and we're moving people in that are going to pay. We actually had March and April March was our very best month we've ever had in terms of move-ins. We had 49 new families move into our communities in March. In April, we had, I think it was 31, and that was actually our second best month. And so, again, we're seeing that same aspect I mentioned earlier, kind of increased demand for this affordable type of housing. The chart on the right is showing our projected investor distributions. So we anticipate, and we're on track to start distributing quarterly to investors after Q1 of 2021.
That's great. Hey, Sam, real quick, I wanted to introduce my partner at ozpros.com, my Opportunity Zone advisory service business. Ashley Tyson just joined us as a panelist, and I know that he may want to ask you some questions about your financial numbers here. Ashley has a lot of experience with mobile home park investing and has vetted a lot of these types of deals. So Ashley, say hello if you're on there, and feel free to chime in with any questions that you might have for Sam here live if you want to.
Yeah, thanks, Jimmy. It's a pleasure to be on. I appreciate you guys doing this, and specifically talking about mobile home parks as an asset category. I think that to you guys' point, that there's lots of positives. I've been an owner and a developer of mobile home parks since 2005, and they've been very interesting. I will definitely say that. As Sam, I'm sure that you have a number of stories about different interactions, but as a whole, they've been very, very financially beneficial, and have made it through recessions, and then have done extremely well in the the up times as well. So I don't necessarily have any specific questions about your financials. You and I talked previously about some of the due diligence items and some of your management items that I think that's one of the kind of crucial pieces that is out there with respect to the mobile home park industry as a whole. Is what mechanisms do you have in place relative to how you're able to to be able to hit these numbers, and in that kind of stuff. And I think we could hit that later on. But these numbers are certainly pretty good, and that Q2 is actual numbers, correct?
That's right. So what it is, all of that's been annualized, but through yesterday. So we just took the quarter through May 26th and then annualized that, and those are the numbers. Yeah.
So even through the COVID, it's kind of been the height of COVID. You're still. It looks like you're actually tracking better. And I would imagine too that's probably because you've been ramping up. But your numbers look good relative to even the COVID play.
Yeah. Thank you, Ashley. Okay. Well, let me share a little more regarding our financial projections. So there at the top, you'll see we're projecting for a limited partner, for an investor, an IRR of around 22% over the hold cycle, or actually over a 10-year horizon, equity multiple of 3.5, and an average cash on cash to the investor of 11.4%. I think the graph below is going to explain a little bit about how the business works, how our model works, and we'll go into it in some more detail a couple slides from now as well. But basically the idea is, we make the initial investment, and like I said, we are buying current cash flow, but we're then going to be able to start distributing. We basically don't distribute that first year. We start distributing that starting in that second year. So you can kind of see those distributions go up. And that's as we do a few different things. Number one, we're infilling the parks. We're bringing in new homes. Number two, we're operating them much more efficiently. So I think I mentioned a little bit ago, a lot of times we'll buy a community and there might be on the expense line, $6,000 or $7,000 a month being spent on water and sewer, and those costs are not being recaptured from the residents. And the reason is the residents don't have a meter on their home to say, well, how much should they get charged? And so we'll go in and we'll install sub-meters at each home, and then people start paying, just like all of us that don't live in a mobile home community, we pay for the amount of water that we use. So anyway, then you see in year 5 and year 10 these big spikes, and let me kind of explain that. So as a mobile home community, it's pretty simple in some ways. It's valued based on a multiple of the net income. And so as we do these things, and as we add occupants, as we increase our efficiency, as we raise rent, one I didn't really mention, then they become more valuable. And as they become more valuable, we have an opportunity to recapitalize the communities. And so what you're seeing here is in year 5, the way we operate these we're buying these value add communities, and our intention is that within the first 5 years, we're going to recapitalize a portfolio and return to the investors their original investment. Doesn't mean that they no longer have shares in the company, right? They bought shares, and we still own these. The preferred return goes away, but they continue to own those shares, and they continue to get their profit percentage of the cash flow that's generated. And then the same thing in year 10, because by year 5 we're not done. I mean, we've added a lot of value, but we might only be at 75% or 80% occupied across the portfolio. There's still a lot of room to add value, and that's what we're projecting there in year 10 as well.
Well, sorry to interrupt you there, Sam. Really great numbers there.
No problem.
Thanks for providing those projections. Ashley, I don't know if you had any other questions or if you're okay with everything he said there. Any other questions for him?
No, I actually really like the visual there, because it shows you over on the left side, the red, and that's where you're putting cash in. And then, you bleed a little bit while you're getting it up to, to stabilization. And then at stabilization, you're getting basically not only your money out, but then a pretty nice little chunk of change as well in year 5. And he's past the 2-year, refinance lockout at that point. And so, then the remaining cash that comes out is just, it's kind of gravy at that point, and a residual. And I like the visual on that.
And I like the year 5 return from disposition, because that's about when your capital gain taxes from your deferred capital gain would come due about that time. So you have a little bit of liquidity as an investor. Is that kind of a little bit of the reasoning behind that as well, Sam?
Yeah, I mean, it's maybe more serendipity than anything as far as, that's just kind of how the business model works out. But, you're right. I mean, that'd be in time for people to pay those taxes.
It's the cherry on top, if nothing else.
So Sam, I do have a question about that. So do you already have lenders lined up for that recapitalization?
Well, I did want to kind of mention a little bit here. So some of these communities, I'll take, for example, in Fund 4 in January, we purchased a community in Greenville, North Carolina. It's 267 spaces. A beautiful community right across from a couple manufacturing facilities, Thermo Fisher, DSM, Diana. And that's going to be a fantastic Fannie loan in 5 years, and maybe earlier, right? So as you know, Ashley, any community where we can get Fannie financing is going to be amazing, because we're going to get 3% money, and it's just going to write in a lot of cash out and that sort of thing. Not all of our communities we're going to be able to do that with. I would say out of the 9 we've purchased so far, Probably 4, maybe 5 of them we're going to get Fannie money on. The others, it's going to be, long-term. At that point, the CMBS markets will be back, and maybe it's a CMBS loan, or it's a great 10-year loan with a kind of regional local bank, something like that.
Okay.
Good stuff, guys. And Sam, you can move on to the next slide, but before I turn it back over to you, I wanted to launch our second poll question for our attendees, and we'll give you a few seconds to vote on this one. Which of the following best describes your primary motivation as an opportunity zone investor? Are you in it for the social impact component, the return on investment, or the tax incentives? And then, I don't know, maybe I'm missing something. So I included an other option. And if you do answer other and you want to chime in the webinar chat function, I'd love to hear what your other reason is. So feel free to chat that message either to me privately or to all the panelists or to all the panelists and attendees. There's a way to use a little drop down there to select who exactly you want to send that to. I'm curious to hear from a few of you who have voted for other already. So I'm just going to give this a few more seconds to run. And while you guys finish up the voting on that, I want to remind you that we are going to have an opportunity for some Q&A with our expert here today, Sam Hales, at the end of today's session. We've already gotten several great questions coming in. I've flagged many of them to ask Sam directly toward the end of our session here today. So just a few more seconds here to vote. Which of the following best describes your primary motivation as an opportunity zone investor? Social impact, return, tax incentives, or other? I'm going to end the poll now.
So Jimmy, you robbed me, man. You didn't let me vote. It said I was clicking away right on tax advantages, and it said that panelists can't vote. I'm like, what's up with that?
I'm sorry, Ashley. We'll get you in there next time. All right, so add one more to tax incentives for Ashley Tyson there. But I'm sharing the results now. You can see that the people here on the call today are in it primarily for the ROI. Nearly half of our respondents in it for the ROI. Fairly similar number in it for the tax incentives, and then a handful of people interested in the social impact. And I've got a few people who have chatted to me what the other is. One person saying to learn the business, and yeah, that's about it. So not a whole lot else going on other than the ROI and the tax incentives. Those seem to be the primary two. So. Sam, I'll turn it back over to you now, and I'll try not to interrupt you until we get to the end here now.
No, that's great. I mean, those are certainly a couple good reasons. So let me talk about, and maybe a little bit of this is on the social impact side, but here's some examples of some capital projects that we've done. So new driveways, we'll put new asphalt down in the communities. We'll build a new children's park. We've got some kind of barbecue pavilions going in. We're doing new signage at basically all of our communities, kind of standardizing that, grading for new lots. Again, so a lot of this is kind of centered around improving what's already there, right? So it's development to some degree, but it's really improvement of what's already existing. And one thing I've shared with our team, a little analogy, I suppose. I don't know how many of you rode the bus to middle school, but I did, and it wasn't always a pleasant experience. And so I have what we call the bus test for our communities, and that is when you think about a kid in 5th grade or maybe he's in middle school, and he's getting off the bus at our community that we own. If the kids are making fun of him because of where he lives, we're not doing our job. And honestly, most of the communities that we purchase, they probably did get made fun of. So that's kind of the idea. We're looking to improve these communities, make it a place where people are proud to call home and are happy to be there. And it really, in the grand scheme of it, doesn't cost that much to do some of these improvements, and just the stories over the past few weeks with some of these projects that have just been getting completed have been really inspiring and really fun. Okay, so here are the QOZ properties that we've purchased so far. First two are in Fund 3, which is also a QOZ fund, but the others are in Fund 4. And you can kind of look down the list and see sizes and number of lots and how many are occupied, how many are vacant. A couple things I want to point out. So first of all, our locations, right? So we're in Bloomington, Indiana, home of Indiana University; Greenville, North Carolina, home to East Carolina University; Daytona Beach, Florida; Lakeland, Florida; Rockdale, Texas, which is outside of Austin, kind of on the way to College Station; and then Las Vegas, Nevada. So we have filters around, hey, this is where we're going to invest. These are the types of communities, type of demographics we're looking for. One thing to keep in mind about mobile home park investment, it's not like we can pick a market and say, hey, we love Charlotte, North Carolina, we love Raleigh, North Carolina, we like Nashville, Tennessee. We're only buying in those markets, because if we did that, we wouldn't be able to really find investment opportunity. So we kind of have to be willing to go out into some of these other markets that are maybe tertiary, but again, they've got to have support. We're not going to buy something in kind of rural Georgia or rural Mississippi where there's not an economy to support people living there. Or you think about maybe some of the Rust Belt states where people are leaving. We're not interested in those states either. I mean, we're looking for places where there is economy, there's population growth, and there's solid numbers to. What we found is, in fact, this was research done by Dr. Charles Becker out of Duke University, and what he found is really the only metric we need to look at in terms of replacement housing for mobile home parks or for mobile homes is a 3-bedroom apartment in that same MSA. So that's the key metric right there. We look at that. We look at that ratio, and it's got to support the kind of lot rent that we need over time to make it economically viable. The other thing I'll mention real quick is I said at the beginning that it's very difficult to build a new mobile home community. However, what's much less difficult is to add lots to an existing community. And we have a number of those opportunities in this QOZ fund. I'll mention a couple. So Los Robles in Rockdale, Texas, we've already met with the county on this. It's currently 84 sites. It's permitted right now to add another 100 sites. And so we're in the process of kind of getting all the construction permits together, so we can start that. We're filling up the existing community as well. In fact, this is one of the ones that just had new driveways and asphalt put in last week. Another one is in Las Vegas. So as you'll see there, we purchased that community with 53 in-place lots, and we were looking to initially kind of keep what was there and then add another 25 spaces. But we knew it was zoned for a lot more than that, and we're now working with the county, with Cook County, to do 150 units on that property. So instead of just adding 25 here, we'd be adding almost 100 units to that one. And so those are fantastic kind of upside opportunities that haven't really been captured too much in our projections, but kind of gravy on top of that. So let me share a little bit about Saratoga Group's history and track record. So we own 26 communities with about 2,300 lots, so close to about 100 units per community. We're in Florida, kind of northern Florida, Georgia, Atlanta area, Alabama. It's actually closer to Columbus, Georgia, right across the river. We're in North Carolina. We're in Indiana, Illinois, Las Vegas, and then we have a couple in California as well, and then Texas. And we have our headquarters here in Northern California, Sacramento area, and then we have some of the management spread out geographically, kind of close to some of these locations. So our senior regional manager, Josh, is located in Springfield, Illinois. So he's covering the Midwest region. Our COO, Luke, who's my brother, lives in Nashville, Tennessee, and so he's proximate to kind of things both in the Southeast and in the Midwest. And then I want to just kind of explain this chart really quickly. This is not Fund 4. This is actually Fund 3, which was our previous QOZ fund, but we've got more operating history there, and I wanted to kind of point out our experience, how it's worked so far, and how we think it's going to happen in Fund 4. So what you notice is that initially the revenue, and sometimes it dips a little more than this, but certainly the income dips as well. And the reason for that is, I mentioned most of these sellers are kind of mom and pop owners. I mean, they might have been the ones that built it, or maybe their parents built it and the kids have inherited it, and they really have not reinvested into the communities, and they don't have very good protocol for screening the people that are coming into their communities. And so what we find is there's often a little bit of a criminal element. There's just some bad apples that we need to get out of the community. And so initially, our expenses are higher, our occupancy is going to dip a little bit, because before we bring in the people that we want to come in, we have to clean up and stabilize what's there. And so that's why you'll see a quarter or two of kind of this dip before the income, the revenue and the income start to increase. So again, this was Fund 3, our previous QOZ fund, but we anticipate very similar performance, and we're starting to see it already on Fund 4. So Ashley, you mentioned, I think you said management practices that help reach the numbers that we're talking about here, right? And this is, to me, I think this is the very biggest risk in this space, is that you can imagine you've got communities spread out all over the.
Yeah, that's why institutional capital is not in this space, right? Is because specifically because of the management risk. Yeah,
it definitely is the biggest challenge, I would say, and I think also the biggest opportunity. And this is for what I tell people. It's like doing, owning, investing, and managing mobile home parks is more like running a business than it is real estate. I mean, the business part of it is more important. And we realized that going in. I mean, we've done a lot of research, but in that way, I think very different than most other real estate. I mean, you always hear you make your money on the buy, and that is certainly true. I believe. I mean, I see every day opportunities where you could overpay for a mobile home park. If you operate it well, it probably isn't going to matter. I mean, look, we don't want to overpay anyway, right? But at the end of the day, the operation is so critical to the success of the community. So, and we've learned a lot in the past few years as we've been owning and operating these. And so what we've tried to do is, as much as possible, adopt, industry standard software and processes and procedures. The challenge is there's not, unlike, let's say, the multifamily space where there's very sophisticated owners, very sophisticated property managers, that's not really true in the mobile home park space. And so some of this we've been able to kind of glean and put together, and some of it we've had to build and create ourselves. And I just want to mention a couple real quick. So we're using Rent Manager, which is quite industry standard. A lot of operators are using Rent Manager. And one of our concerns early on is how do we market effectively in all these different markets we're in, and make sure we're getting the word out about what's available, and making sure that we understand our sales funnel and what's coming in and our conversion rates. And so anyway, we adopted another platform called Show Mojo that automatically syndicates out of Rent Manager, pushes it to all these markets, and we can look at heat maps and really drill down and see how we're doing in every market. And that's been huge for us, and to make sure that we're in those markets, and our ads are up all the time, and we're getting a lot of a lot of connection that way. Two other things is really quickly. I know we need some time for Q&A here, but a QOZ web crawler. So we've both built a database and like I said, a web crawler that goes out and knows how to identify, based on address, if a community is in an opportunity zone, and then if it's either been listed for sale or if there's some chatter about it that, it may become available. And then I get an email every morning if there's a new property that becomes available or may become available. And then finally, just some custom automation. So we're in 9 different states right now. We're going to be in 11 next month. And in each of these states, there's different rules about, how long do you have till you need to give notice about a rent raise, and all these different rules and timing. And so what we did is we built a lookup table with all that information for each state that we operate in. And then we have a wiki site. Each of our managers, when they have a new resident ready to move in, they go to the wiki site, they fill out this simple template, it populates the contract, and automatically, looking at the address, knows where they are, knows all the rules, takes that information from the lookup table, sends the contract out to the client as they're sitting there with the manager, and then also the regional gets notified. They can all execute the document right then, and they can walk out after they paid their money with a new home. So that's really it. And I know we wanted some time for questions. So anyway, thank you so much.
Yeah, that's great. Thank you, Sam. Thanks for joining us today and sharing your expertise with us. Why don't you keep that final slide up on the screen, actually, Sam, so people know where to go to learn more about the fund and to access the slide deck. I'm going to send a link in the chat window right now too. You can, if you're interested in downloading the slide deck, you can do so by heading to invest.saratogagroup.net. Register and Sam will get that slide deck over to you. Or actually, I think it's on that page after you finish registering. So that's how you can access that. And just a reminder, we're going to send a follow-up email to everybody tomorrow that will cover a lot of this stuff I'm talking about right now. Where the recording will be able to be accessed and where you can access the slide deck as well. So as we move into the Q&A portion of today's webinar, and by the way, we've got a lot of great questions. I don't think we're going to get to all of them because we've gotten so many. If we don't get to your question, I'm going to put it on Sam to see if he can have either him or someone on his team try to get back to you soon. I'll try to forward any of the ones that we don't get to on the webinar today to get personal answers from his team shortly. So balls in your court on those, Sam, if we don't get all these answers today. But before we move on to the Q&A portion, let's launch our final poll. Sam wants to know, hey, how interested are you in his QOZ fund? So do you plan on investing in the Saratoga MHP Fund 4 within the next 6 months? That's about 180 days from now. If you have capital gains recently, you have 180 days to roll them over. This presents an interesting offering. So please answer this question. I'll keep this up for a minute or two while we dive into the Q&A. So Sam, first question, we've had a lot of people express this sentiment or something similar to it. If you could kind of go over the distinct advantages of combining mobile home community investment with opportunity zones. And one question from John coming in is, are mobile home parks in opportunity zones as profitable as non-opportunity zone opportunities? Are there differences in path of development, et cetera? And if so, do you invest in more profitable MHPs outside of opportunity zones as well? And then another question he has, a follow-up question, that is, how do you ensure that you meet the 70% of the business's tangible property test? So kind of a loaded question for you there, but go ahead.
Yeah, 2 parts there. So the first question regarding maybe distinctions between properties that are in opportunity zones and not in opportunity zones. So as many of you are aware, if you've been looking at OZ investment and maybe OZ funds, as the community, I'm just going to say that in terms of the investment community, started to understand that there was opportunity or that there were these opportunity zones, property prices spiked in a lot of places. And the reason for that is you kind of had a relatively sophisticated seller base, and of course, sophisticated buyers, and so supply, demand, and prices went up. We saw early on some, I'd say, aggressive pricing for broker listed properties in opportunity zones, thinking that, hey, that, you know, there's kind of a chance to capture more money here. But what we've generally found, at least for what we've purchased, is that the sellers are pretty unsophisticated. So most of the sellers that we purchased property from in opportunity zones didn't know what an opportunity zone was. And at first, the brokers didn't even know. The brokers kind of understand now, and so they know, but I think they're also seeing that it really hasn't made a huge difference because there's not that many people doing what we do, which is looking for mobile home communities and opportunity zones. The second question, Jimmy, I'm going to need to answer that by email because that's kind of detailed.
Yeah, sure.
So there's a whole bunch to explain there, but please send their information and we'll answer that by email.
I will. And really quickly, I've got a couple people asking, what's the minimum investment amount for this fund, for Fund 4?
Minimum investment amount, is $100,000.
Good, good. Another question here. If you're buying cash flowing MHPs, how do you fulfill the substantial improvement requirements? Does this business model comply with the no triple net lease regs?
Okay, so yeah, let's tackle those two quickly and separately. So in terms of the improvements, you know, so one point is when you're buying a mobile home community, I kind of mentioned the purchase prices. So we found, and we do an independent appraisal on each purchase, that typically the land value is coming in right about 40%. So if you're familiar, you know that you don't have to double land value, so you're only doubling the basis. And on most of our communities, that 60% that's less, by the time we add, we do brand new roads, we put in streetlights, we do community amenities, we fix all the things that are broken, and sometimes meet some new distribution lines. We're already meeting that test. In some cases, we're not. So, for example, in Daytona Beach, Florida, those communities, we don't meet that. We're not going to meet that simply by reinvesting into the property. And what we're not willing to do, it doesn't make sense to overinvest and kind of overimprove simply to meet the tax legislation. However, we also, as long as we can bring in new homes, if we lease out those homes on a lease option contract, which is what we do, and we maintain ownership over those 10 years, then those new homes that come in and are set and become real property at that point are going to count towards that basis as well. So we're probably, at the end of the day, we were looking at it, we're probably going to be bringing in close to $20 million worth of homes on a basis that's maybe going to be, $7 to $9 million of basis.
Good, good. Thanks for the answer there. Another question deals with the eviction process. Someone wants to know, how does that work exactly in a mobile home community? Given the semi-fixed nature of the homes, I would expect it is more complicated. This questioner asks, what are your thoughts on that, Sam?
No, that's very true. It works, and of course, it does depend a little bit on which state you're in, but generally speaking, it's similar to a standard eviction. I mean, there's even a sheriff lockout and all that sort of thing. But a lot of times if they get, they get evicted, so to speak, from their space, most of the time they're actually going to end up abandoning the home, and then we have to go through an abandonment process to get title to that home, or they're going to take the home with them ultimately, because if they own the home, right? We don't own the home, but we can't evict them from the community because they're not paying their space rent.
Right on. And kind of along those lines, a little bit, a question from another attendee, Chris, asks, how do you keep the mobile home parks from becoming a poverty trap for the occupants? High tenant moving costs, depreciating asset, increasing lot rents. Many states prevent homes past a certain age from being moved, et cetera. What are your thoughts on that one?
I'm very sensitive to that question because I've certainly seen that where residents can be trapped and owners are happy to raise rent, but not willing to improve the properties. And yeah, and you know, I guess I mentioned the bus test. I mean, but we're very focused on improving communities, whether they're in an opportunity zone or out of an opportunity zone. And you know, often our rents are significantly below market when we buy them, and we will get our rents up to market over time, but we're going to do it gradually and responsibly. And I, you know, at the end of the day, I mean, it's, for example, if you're an operator that didn't reinvest in the community, and you know, we come to a recession like this. So I showed that chart at the beginning showing, hey, you know, mobile home parks did pretty well in 2009, 2010. That wasn't true across the board. So operators that had a high preponderance of park-owned homes, where they're just renting out the homes, and in a combination with they didn't invest in the communities. They basically were slumlords. Saw a dramatic hit to their business. And so I think that's what happens, right? Is at some point people say, hey, yeah, I do have money invested in this property, in this home, but if I can't get basic services and I can't flush my toilet because the owner won't upkeep the services and the infrastructure, they are going to move.
Good. Well, good answer there. I'm going to shift gears a little bit and get back to your financial projections for a moment. We've got a couple questions regarding those. Joshua asks, what are typical equity share percentages, or what are typical equity share percent would you give to someone investing $100,000 based on that example you provided when returning their investment after 5 years?
Okay, so yeah, the way that this fund is structured, very similar to everything else we've done. There's a preferred return and then there's a profit split. And the preferred return for Fund 4, 7%. So the first 7% on an annualized basis of the profit goes to the investor. After that, it's a 70-30 split. So 70% goes to the investor and 30% to us as the sponsor.
Good. And then another question on that cash flow projection you were showing. Ram asks, is the cash flow mentioned of $17,000 passed on to the investor as an example in year 4? I don't know if you want to maybe pull up those numbers again.
Let's go back to that.
While he's pulling that up, let me comment real fast. I mean, that's actually a really attractive split. You know, most of the deals that I'm seeing, Jimmy, is, you know, I'm talking on these calls is, you know, there's usually a pref and then some kind of split, like a 70-30 split to another hurdle, like a 12% IRR hurdle, and then it goes 50-50, maybe to a 15, and then, you know, it's usually inverted in favor of the sponsor. So the fact that you're just splitting 70-30 after that, that's actually really generous.
And I don't quite know how to take that. I think I should say thank you, but.
Yeah, well, I mean, it's it's kudos to you, and you know, makes the deal even more attractive. You know, I'm actually exiting my mobile home park. I'm gonna be calling you. I can take all that management headache off of me.
Yeah, no, there's a lot, you know, because you operate.
Yeah, it's crazy.
So to Ram's question, yes, in year 4, what that's showing is that's the cash flow from operations to the limited partners. So yeah, in year 4, our projection is that'd be $17,000 in cash flow. Nothing to do with recapitalizing or anything like that.
Right. The recapitalizing or the return from disposition happens in year 5 there. So in year 5, there's cash flow of $18,000 change plus an additional $111,000 disposition amount. Is that right? Am I reading that right there?
Correct. That's correct.
Right.
Yeah, and maybe one other thing I'll point out real quick, Jimmy, is just so year 6, you see the cash flow drops back down. Well, that's because we've obviously put some new leverage. There's more leverage on the combined portfolio, and so we're seeing less cash flow on that. But you know, it's still at 9%, right? I mean, pretty good.
Right on. By the way, we are at the top of the hour, so just wanted to Make sure everybody's aware of what time it is. We're at 3 p.m. Eastern time now. So if you have to hop off, we won't hold it against you. I know some people probably had hard stops here at the top of the hour, wanted to make sure you get out of here on time. Sam, if you don't mind, I've got some time to keep going with some of these questions and answers if you've got some time to field some more.
Yeah, no problem.
Okay, good.
Sam and Jimmy, it's been
I'm
a
gonna hold you
pleasure.
hostage for a little while
I gotta
longer.
jump on a call, but thanks again, Sam, for the presentation.
Yeah,
Cheers.
thanks, Ashley.
Thank you, Ashley. But Sam and I are hanging out here for a little while longer. I'm going to hold Sam hostage until we get through some more of these. Let's see. Someone asked, in an opportunity zone fund, capital gains are tax-free if held for the full 10-year hold. That's true. But that said, with that year 5 recap distribution be taxable, I assume so. And I answered him saying that, yeah, I believe they're taxed as ordinary income, but I want to confirm with you, how are those taxed?
Well, so we're working on that question with our accounting firm. We actually believe the answer is it's not.
Oh, really?
Well, our understanding, well, not up to the amount of returning the initial capital. That would be tax free. Everybody needs to get certainly their own advice on this, and we're going to try to put something together more kind of authoritative on it. But our understanding so far is that actually up to the return of invested capital, that would be a non-taxable event.
Oh, so that's fascinating then. So then, and again, we're not 100% sure about this. This is a little bit in the gray area because this is such a new program, and different accounting firms might give different advice. And we would urge you to please talk with your accountant about this. Absolutely. But what you're saying is your accounting firm's interpretation is that any distributions up to the original investment amount. So if I invest $100,000, the first $100,000 you return to me is tax-free because it's not really income. It's just a return of investment capital. Is that right? Do I read you right?
That's correct.
Oh, that's really interesting. Okay, well, I'm glad I asked to confirm that with you. So that question was submitted anonymously, so I can't address you by name, but whoever had that question, that's Sam's thought on that. And please check with your tax advisor, though, to confirm.
Sure.
Let's see a few other questions here we can get to possibly. Oh, do you provide homeowner financing?
Well, okay. So we do not provide financing. To do that, there's a lot of hoops you have to go through to get that approval. We do provide the construct of a lease with an option to purchase, which is also a path to home ownership. It's not financing, but they lease it for a period of time. And there's very specific things that we have to put in there to make sure it's not construed as a financing agreement. But that's actually how we mostly get these our new occupants is through this lease option structure. And in fact, as we discussed, if we're bringing in new homes, that's important to us. We couldn't do a straight finance where they take ownership right away because that would then not count towards our improvement basis for the fund. And
Good.
of course,
Okay.
the test goes, as you know, Jimmy, on an asset per asset basis. So it's not
Right.
just across the fund. Yeah.
Right. Patrick asks, in the past, Sam, you've talked about holding these assets forever rather than 10 years. So Patrick might be somebody that you've spoken with previously. Maybe he's heard you elsewhere before. Is that still your thinking here? Because I know we're talking in terms of OZs. The 10-year mark is that critical mark. But what are your thoughts there on forever versus 10 years?
And Patrick, thank you for chiming in. Yes, and I just want to pull up this slide as we talked about it a little bit. So, imagine you're an investor. You made your initial investment. It's in an opportunity zone. You got all your capital back, which, as we talked about, is you pay some taxes on it, but the important thing about an opportunity zone fund, I believe, is that there's potential. I mean, if it's a good fund and it does well, that all of the gain above your contribution is tax-free. So our thought is, hey, we hit year 10 here, and of course these aren't precise when this is each asset's going to recapitalize and that sort of thing. But the idea is if an investor has their money back and then they're still getting a distribution every quarter, what is the value and what's the impetus to sell? We could, we have to hold it for 10 years. We know that much. So we could sell it after 10 years, or we could sell it after 30, right? Because if we sell it after 30, as we continue to grow the asset value inside of the fund and investors continue to get distributions, we believe that that's probably the best thing for the investors. Our thesis, as Patrick pointed out, our thesis is once we find a community and we've fixed it up and it has good cash flow, that's very hard to replace. It's very hard to go out to the market and find to sell that and then go find something else. I mean, we know we could sell it, a great price and that sort of thing, but it's the reinvestment problem. Like, what do you do next? Because it's really hard to find, because of the limited supply, to find these opportunities.
Gotcha. That's good. Question from Joshua here. What's an average % of revenue that you are investing into the park?
Average % of revenue. Well, let's see. Let me. I'm just going to think out loud about this so I can answer the question. I've never thought about that particular question, but
yeah, and maybe we can get back to Joshua via email later if you want to.
Yeah, but I think I could think about it real quick. So if it's a $2 million purchase and we invest another $1 million into it, $2 million, and let's call it 10%. That's 200. I mean, yeah. So we're usually probably going to be, 5 to 10 times initial revenue, in terms of our investment.
Gotcha. Put you on the spot there with that one.
Yeah, no problem.
Absolutely. I might put you on the spot with this one here too, actually, because I don't know about this one, but there's a question from Bobby here. It sounds interesting. I've read that you can take the full 15-year depreciation of MHP in year one of an MHP. Can you elaborate more on how depreciation is used to boost the investment for the potential investors? Do you know anything about that one? Thoughts there?
Well, I do. Enough to be dangerous. So, first of all, again, not giving out accounting advice here, right? Because I'm not qualified to do it. But let's say this wasn't in an opportunity zone, because the opportunity zone layer kind of complicates things because people are coming in and maybe they don't have basis in the money that's being invested. But if you weren't in an opportunity zone and you bought a mobile home community, as part of the 2017 jobs, I always get this, it's the Jobs and Tax Cut Act. It wasn't the Jobs Cut Act, but anyway. In that part of the legislation in there was this provision for bonus depreciation. And what it says is, it doesn't matter what kind of commercial real estate, mobile home park is one type, but any portion of commercial real estate that is on a depreciation schedule of 15 years or less, you can depreciate all of it in the first year. Now, what's interesting about a mobile home community, again, take off the context of an opportunity zone fund, but for a mobile home community, everything, and that's qualified because maybe not in some cases, but typically everything in the mobile home community is on a 15-year or less schedule, right? Think about roads, fences, sewer lines, water lines. Those schedules are all less than 15 years, which means you get to write off everything, all of the improvements in year one. So outside of an opportunity zone fund, our investors, let's say they invest $100,000 in fund one or whatever, that first year they got a K1 that says, thanks for your investment, you lost $100,000. It was all written off.
Okay, great. So I think we're already about 10 minutes over. I'll just hit you with a couple more questions. We're not going to get to everybody's question. I mean, we could probably spend another hour or two here answering all the questions that have come in. So if we didn't get to your question, I apologize, but just a couple more before I let you go here, Sam. This one comes from Robert. He wants to know if you've done comparison with MHP versus self-storage facilities. How do those two different asset classes stack up?
Oh boy, that's a good question. I'm definitely not an expert in the self-storage space. Let me tell you, but I looked at it. I took a hard look when I mentioned, moving our group into a recession-proof industry. There's some similarities there with self-storage, right? So in a downturn, people are often consolidating households, and there's kind of more demand on self-storage, and so it has some similarities there. The reason we chose mobile home communities over self-storage, there's a couple of them. Number one is because of the supply aspect. So it's relatively easy to build new self-storage, and there's been a lot of it that's been built over the last 10, 15 years. Some markets, it's abundantly oversupplied, and I could go into some of that. On the mobile home side, mobile home community side, it's very difficult, as I mentioned before, to get or for the ability to actually build a new community. The second thing is, in terms of one of the advantages I mentioned earlier regarding consolidation and the fact that the mobile home park investment kind of across all 50,000 communities is very fragmented and very little institutional ownership. That was true of self-storage 20 years ago. And I'm not an expert there, so I don't know all the history, but I do know that public storage and a lot of these big Wall Street firms came in and they started doing roll-ups and buying up a lot of this. And I don't know the ownership percentage now, but I'm pretty certain it's over 50%. There's some people that feel like that's going to happen on the mobile home park side, and if it does, good for everybody that bought before that, because that's going to be great for values. And there's some of that has happened. Certainly, Blackstone's gotten into it a little bit, but I think what a lot of them are finding is it's tough. Like, it's tough to operate these because you've got to be pretty nimble and lean. And so, anyway, those are a couple of the reasons that we like the mobile home park space over self-storage. Okay, excellent. I got one final question here from Larry, and then I'm gonna turn you loose. And I apologize for anybody whose questions we didn't get answers to. We'll try to see if we can reach out to you individually and get you your answers later. But Larry asks, how do you handle an old home that you get a title turn in? Do you replace the home with a new home? Yeah, good question, Larry. So again, because we're in the affordable housing space, what we find is there's more demand for an inexpensive home than there is for a new home. And so what that means, initially when we got into the business, we probably were a little too aggressive on demoing homes. And what we've learned is it costs a lot of money to bring a new home in and set it up. I mean, even if you were to bring in a nice used home. And so we'd rather spend the money on fixing up that home. It's already there. We know how much it costs to get out and bring in a new one and make it as nice as we can, because there's going to be a whole bunch of people that are going to qualify for that home that if we bring in a brand new home aren't going to qualify for it. And that's the space we're in. So we want to make it affordable, and that's typically what we're going to do. Excellent. All right. Well, again, that'll wrap it up for today. We have a lot more questions I know we didn't get answered. We'll try to get those answers out to you individually over the next day or two here. Before we go, thank you, Sam Hales at Saratoga Group, and thank you to all of our attendees. If you're interested in learning more about Saratoga Group and their Opportunity Zone Fund, head on over to invest.saratogagroup.net. You can register for their investors portal. No obligation there, but you'll have access, excuse me, you'll have access to some of their investment material, their brochures, and today's webinar as well. You'll be able to download today's slide deck. And then again, just to remind you, we will be sending out a follow-up email tomorrow afternoon with some additional information as well pertaining to how to access the recording of this webinar and to how to access some of those resources at Saratoga Group and the webinar slides as well. Again, thank you, Sam, and thank you all for attending. I appreciate it. Thank you, Jimmy. Really appreciate it. Thanks, everybody. All right, take care, guys. Thank you.